just received a confirmation of the bonus being credited to your bank account. What do you plan to do with this money? Use it to prepay your outstanding loans? Or will you invest this money? If this question is in your mind, watch this video till the end as I help you make a decision. Hi there and Namaste. I am Harshvardhan Davar and welcome to our new series called This or That. In this series, we will discuss the various dilemmas faced by investors and the factors you must consider before making a decision with respect to your money. The topic of today's discussion is, what do you do with the surplus money lying in your bank account? Should you use that to prepay your loans or should you invest that money? The decision is a function of the cost of the loan that is outstanding in your name and the returns you can expect from investing the surplus that is lying in your bank account. Let's look at the various loans which would be outstanding and what should you do with them. The first one is your credit card loan. Credit card loans generally come with an interest which varies between 3 to 4% per month, which translates into an annual cost of 36 to 48%. And these are loans which you should definitely prepay without giving a second thought. Similarly, if you have any personal loans outstanding, the cost of which can again range from 12% to 18%, you can definitely go ahead and prepay these loans because the risk of carrying these loans outweighs the returns you will expect from investing this money. So if you have credit card loans and personal loans, these are definitely good to get prepaid right away with the surplus lying in your bank account. Next, what happens if you have an education loan or a home loan outstanding? Now here it gets interesting because the interest on these loans is deductible as a tax expense when you file your income tax returns. Then, should you prepay your education loan and home loan? To help you answer this, we have 3 checks which I want you to run through before you make a decision of what to do with the surplus lying in your bank account. Check number 1. If your home loan EMI is more than 50% of your take-home salary, you should definitely prepay the loan. The reason being the EMIs are being a strain on your finances and you should do whatever you can to kind of reduce this monthly strain and bring it down to a more comfortable level of about 30% of your take home. If your EMI is already at 30% of your take home, then you are more comfortable with respect to your cash flows on a monthly basis and you can consider continuing the home loan to take advantage of tax benefits associated with having a home loan for a longer period of time. Check number 2. If you decide to continue with the home loan, then you need to compare the cost of your home loan with the expected returns on the investments if you were to decide not to prepay the loan and invest the money. Keep in mind, both of these need to be compared on an after-tax basis. What do I mean? If the cost of your home loan interest is 8% and you fall in the 10% tax bracket, the post-tax cost for you is only 7.2%. If you fall in the 20% tax bracket, the actual cost for you is only 6.4% because you're getting a tax rebate to the extent of 20% of the interest you're paying. And if you fall in the 30% tax bracket, your net interest cost of your home loan after getting the tax benefit is only 5.6%. So the number which is relevant for you is 7.2, 6.4 or 5.6 depending on which tax bracket you fall under. For the sake of this example, let's assume that you fall in the 20% tax bracket and the post-tax interest cost for you is 6.4%. If you were to not prepay a loan and go ahead and invest this money and put the money today in a fixed deposit, the approximate return you earn from a fixed deposit is 6%. And after paying a tax of 20% since you fall in the 20% tax bracket, the post-tax return is 4.8%. If you were to compare that with the post-tax cost of your home loan, which is 6.4%, it is pretty obvious that you should go ahead and prepay the home loan because the cost of the home loan is much higher than the expected returns from a fixed deposit. Now, what happens if you decide to not put the money in a fixed deposit but explore investing the money in equities? What is the expected return from investing in equities? If you take the historical average, the return ranges from 12 to 15%. And after taking into account the taxation long-term capital gains, which is at 10%, your post-tax return on equities is going to be anywhere between 10.5%, 11% to 13.5%. Now, when you compare that with the cost of the home loan, which is just 6.4%, it seems attractive that yes, you can explore investing in equities. But the question to be asked is, Should you go ahead and choose the option of investing in equities and take advantage of the excess returns in equities? For that, I would like to introduce our final and third check. Check number 3. Can you manage the risk associated with investing in equities? This is an extremely important question you need to answer, because when you decide to invest in equities, you are not assured of a return. The cost of your home loan is assured. You have to pay the interest on the home loan irrespective of what happens in the stock market or what happens with your other returns and investments. So in a good year, the equity may actually gain and make you the 15% return, and assuming you're able to offset the cost of borrowing, it is a net positive leverage for you. But in a bad year, if the equities fall, you not only land up making a loss in equities, but you also have the cost of borrowing to pay, and it results in a double whammy. That is why the important question of, can you stomach the variability of returns in equity? The answer to that lies in your asset allocation. If your asset allocation says that you should have an exposure of 70% in equities and 30% in debt, and you have already maxed out on equities, then there is no point in going overboard with further equity allocation, that too with money which is technically borrowed and that has a leverage outstanding with it. To sum up this discussion for you, if you have a credit card loan, a personal loan or a car loan outstanding, you should definitely go ahead and prepay these loans, because the cost of these loans will definitely outweigh the expected returns from investing the money. If you have a home loan or an education loan that is outstanding, given that the interest cost of these loans is tax deductible, you can run through the 3 checks we just discussed and see if it makes sense for you to go ahead and prepay the loan, or should you use the surplus to invest and grow your investment portfolio. If you have any such investment dilemmas, do drop in a comment below or write to us at iplan@wealthcafe.in, and we will take them up in our future videos. Do like, share and subscribe to our channel, and look forward to freshly brewed content from Wealth Cafe every Wednesday and Saturday. Till then, it's a goodbye from me, and don't forget to save hard and invest smart.